In this presentation, we're going to discuss the premium tax credit and the rules for when a taxpayer and potentially the family is receiving health care provided through the Mass Health Connector. Information on the premium tax credit can be found in publication, that's the NTTC modified publication 4012 tab H, IRS publication 4491, lesson 26, and a dedicated publication on the premium tax credit, IRS publication 974. What is a premium tax credit? So a premium tax credit, or PTC, helps taxpayers pay health policy premiums as part of the Affordable Care Act. Now, this is the ability that assists people to obtain health insurance by making up the difference they may need to make the insurance affordable for them. They obtain this health care via what's called the marketplace, which in Massachusetts is called the Mass Health Connector. Now, the connector will estimate what the premium tax credit that the taxpayer is entitled to at the time of purchase. That's based on income estimates that the taxpayer provides to them. So PTC can be paid in advance, and in that case, it's called the Advanced Premium Tax Credit, or APTC, which gets paid directly to the insurance company. Now, this may lower the amount a taxpayer must pay for their health insurance to potentially zero, or it could be returned to the taxpayer as a refundable credit, or could result in a taxpayer owing all or some of the credit back on their federal tax return. For most of the taxpayers that we meet, they receive some advanced premium tax credit, and then they receive additional money as a refundable credit. However, we do run into limited situations during tax season where a taxpayer may owe a considerable amount of the credit back to the government. I've worked with taxpayers who owed as much as $7,000 in advanced premium tax credits that they had to pay back to the government. Now, who's covered by this premium tax credit? Well, you have to be enrolled in a qualified health coverage plan from the marketplace. The taxpayer, the spouse, if married, filing jointly, and any claim dependents are covered. The taxpayer will receive a Form 1095-A, and again, in Massachusetts, the marketplace is called the Massachusetts Health Connector. Now, in the intake booklet, there's a question. This is from last year's intake booklet. The 2024 is in draft right now, but it does contain this question as well. Here, it was question 9 under the life event section. It asks, have health coverage through the marketplace or exchange and provide the Form 1095-A. Frequently, we find that the taxpayers don't bring the Form 1095-A or don't answer the question correctly. Now, the term marketplace may not be something they recognize, and they don't understand that we're talking about the Mass Health Connector. So this form is the 1095-A is nationwide. Now, in Massachusetts, we don't call it an exchange or marketplace. We call it the Mass Health Connector. So sometimes people don't even realize that's where they're getting it from. So they just answer that question as no. So we want to ask them additional questions. Certainly, if the taxpayer had a 1095-A the previous tax year, that should generate questions on our side. But maybe for some reason, they now have employer-provided health care, or maybe they turned 65 and now they have Medicare. But if someone had one last year, we should definitely be asking them questions about why they don't have it this year. Now, if they have private insurance, but not Medicare, not Mass Health, not VA insurance, let's say Veterans Administration, but not through an employer, you can ask questions. If they say they have private insurance, and after asking where they get it, they say through their employer, then you know it's not from Mass Health Exchange or the Mass Health Connector. If it's not through an employer, then it's very likely from the connector. Now, there are a few policies that should generate some interest, like the Boston Medical Center Health Net, the Tufts Health public plans. It's not Tufts in general, but Tufts sells public plans, and then the Always Health Partners. Now, those are often 1095-A plans. So if you see them on a Form 1099-HC, it's another health form, just ask some questions. It's possible it's through an employer, but you should ask additional questions and make sure that the taxpayer doesn't have a 1095-A and didn't get their insurance through the Health Connector. So we have to reconcile any advanced premium tax credits that the taxpayer may have received. To do this, they have to file a tax return. Now, if they receive too much, they may have to repay. And there are some limitations depending on what the taxpayer's income level is. If they didn't receive enough, they'll get a refundable credit. So either the taxpayer will have to pay additional tax, or they'll receive additional credits by filing their tax return. In the tax return on Schedule 2, you'll see the excess advance premium tax credit repayment. If a taxpayer needs to pay back some of what they've received, that's where it'll show up. In the case where they didn't receive enough advance premium tax credits, they'll receive the difference on Schedule 3 Part 2, which includes refundable tax credits. Now, you'll see the amount on line 9 is called net premium tax credit. Once we've entered the proper amounts in the software, a Form 8962, which we'll see a little later, that'll be generated and is going to say this is the amount the taxpayer needs to pay back, in which case it goes in Schedule 2, or this is the amount the taxpayer will receive as a credit, in which case it goes on Schedule 3, Part 2, seen here. Now, who's allowed this premium tax credit? Well, taxpayers who are not eligible for coverage other than coverage in the individual market. So they're not eligible for affordable employer-provided plans or from government-sponsored plans like Medicare, Medicaid, which is here in Massachusetts, it's called Mass Health, and the Veterans Administration. Now, those are the ones we most see for government coverage. Now, who is the applicable taxpayer? Let me start out by saying that the amount of advance premium tax credits is set based on a taxpayer's anticipated income during the tax year and determined by the marketplace. The modified adjusted gross income should be at least 100% of the federal poverty level, which in 2024 is going to be $15,060 for an individual. Now, a definition here. Modified adjusted gross income is, in simplest terms, is a person's adjusted gross income plus a few items added back in, like exempt interest or excluded income. There are two exceptions to the requirement to have a modified adjusted gross income of at least 100% of the federal poverty level. First, if you're below 100% and the marketplace granted the advance premium tax credit. Now, why would they grant the exception? If the taxpayer thought their income would be, let's say, 200% of the federal poverty level, and they got laid off in the middle of the year, and their income was lower than 100% of the federal poverty level, well, then the marketplace would still allow the taxpayer to be eligible for advanced premium tax credits, especially since the taxpayer may not have anticipated losing their job. Now, the other exception is if they're below 100% and the taxpayer is a lawfully present alien, but they're not eligible for Mass Health because of their immigration status. Now, the upper federal poverty level limit on who can receive advanced premium tax credits is 400% of the federal poverty level. So taxpayers need to make between 100% and 400% of the federal poverty level to qualify for advanced premium tax credits. Who is a qualifying taxpayer? Well, they have to be lawfully present in the U.S. But a taxpayer who's not lawfully present in the U.S. can get the advanced premium tax credit for a person who is lawfully present. So if a parent is not here lawfully, but their child is, then they can get the premium tax credit for the child. Now, taxpayers can't qualify if they're incarcerated either, but again, their child can. Once again, who's a qualifying taxpayer? Well, if you're married, you have to file married filing jointly unless the taxpayer is considered unmarried for head of household filing status because you're taking a dependent. If you're filing married filing separately, there's also an exception for domestic abuse or spousal abandonment. Now, the taxpayer can't be claimed as a dependent by another taxpayer. The household income for premium tax credit calculations. We're looking at the modified adjusted gross income of the taxpayer and the spouse if filing jointly, and any claimed dependents whose gross income exceeded the filing requirements. So if you have high school kids who are dependents of the parents and they file a return just to get a refund of what their employer withheld from their summer jobs, then you don't have to add any of that back in. But if it's a claimed dependent whose gross income is above the filing requirement, then we'll have to add that. And the software has a place where we can add that in later on. Now, this doesn't include the modified adjusted gross income of the spouse of married filing separately, or head of household. Again, except for a few exceptions, taxpayers using married filing separately as a filing status are not entitled to advance premium tax credits. So the adjusted gross income is shown in the return, but some calculations have to be done to determine the modified adjusted gross income. Now, the good news here is that Tax-Aide will do these calculations directly. So if the taxpayer has some untaxed Social Security, has some excluded foreign income, which we almost never see, or some tax-exempt interest, you won't have to do any of the calculations. And there's no reduction for one-time income. So if someone hits the lottery, that gets added into their modified adjusted gross income and may even disqualify them or significantly reduce their premium tax credit for the year. So if they get a one-time income boost, it does have to be included. Again, the software will do it for you. It's not like you have to do these calculations on your own. Premium tax credit for a family member. They must have qualified health coverage from the marketplace in a Form 1095A. It doesn't have to be the same policy throughout the year. Now, some people have multiple. It's unusual, but it does happen. They can't be eligible for coverage other than through the marketplace. If they're able to obtain affordable insurance through their employer, or they're eligible for Medicare, Veterans Administration, or something else, then they're not going to be eligible for the advanced premium tax credit. Eligible for employer coverage? Taxpayers can't claim the PTC if they're eligible for affordable employer coverage, whether or not they take it. So if a person can get affordable insurance from their employer, but they choose not to take it, they can't then go and buy from the exchange and get the premium tax credit for it. If you see a Form 1095C, that's an indication they were eligible for employer-based coverage. Generally, we rely on the marketplace to make this determination, so you don't have to be policing this, but be aware of what these general rules are. Now, if you're an employee and your employer offers coverage to you, is sometimes called an employer-sponsored plan, that coverage generally is affordable for you if the portion of the annual premium you must pay for self-only coverage that satisfies the minimum value requirement does not exceed 8.39% of your household income in 2024. Now, this percentage is adjusted annually. Now, eligible for employee coverage? If you're eligible for COBRA through an employer, but you decide not to take it, you can still receive the premium tax credits. It's probably because COBRA can be really expensive. You're also eligible if you're eligible for retiree coverage, but you don't take it. So those are some exceptions to being eligible for employer coverage. The marketplace will make the determination. So if the marketplace says they're eligible for PTC, we can accept that, but be aware of some of these other exceptions. Now, what if the taxpayer is eligible for other government coverage? They can't claim the premium tax credit if they're eligible for government coverage, whether they're enrolled or not. For Medicare, they lose premium tax credit starting the first day of the 4th month after turning 65, and sooner if they actually are enrolled in Medicare. Now, most of our taxpayers are on Medicare, and they get it immediately at 65, so it's not usually an issue, but again, just be aware. Now, taxpayers with TRICARE for military, former military, and dependents, they lose the premium tax credit if they're covered on the first of the month. There's other government coverage, Medicaid, which in Massachusetts is Mass Health, and the Children's Health Insurance Program, or CHIP. They're generally paid through Mass Health. Ask the taxpayer if they're eligible. Eligibility can vary, but don't worry too much about it. Generally, people who are on Mass Health or children under 18 that are eligible for the CHIP program aren't paying for health insurance, and they're not going to have a 1095A form. Now, computing the premium tax credit is done on Form 8962. The software does most of the heavy lifting here for you. So most of the things you don't need to do in terms of calculations. The taxpayer will pull what it needs out of the return itself, including whether they had any untaxed Social Security or tax-exempt interest. The software will calculate the modified adjusted gross income as a percentage of the federal poverty level. It's going to list it as something like 283% or 199%. It'll give you that so you don't have to do the math yourself. So you're going to find the policy cost on the Form 1095A, and usually you'll get the benchmark plan, which is called the second lowest silver plan. That's on the 1095A as well. So occasionally it's missing, but there's an easy way to look it up if you need to. So the benchmark plan is the second lowest cost silver plan for those in the household with qualifying coverage. The bronze plans are lower in cost and usually have high deductibles versus higher level gold plans which have very low deductibles. So silver's kind of middle level plan. Now, if the benchmark plan is not shown, go to the masstaxaide.org website, and on the far right under the calculator, there's a section where you'll see a link to SLCSP. When you go into that, it's going to ask you for a zip code, the age of the head of the household, and a handful of other questions. And it's going to basically tell you what the second lowest silver cost plan is, and then you can enter it. Often it's already in the 1095A, but if for some reason it's missing, you can look it up. I don't think I've ever had a situation where I've needed to look it up. Computing the premium tax credit is done on a month-by-month basis. A person could be eligible for certain months, but not others. If they change address, it can be different rates. If all months are the same, you can just take the summary numbers of the 1095A and enter them in, so you just basically enter 3 numbers. If there's any difference on any month, you have to enter in all 36 numbers. So if I have to do this, I usually just do a quick cut and paste, as most of the numbers will be the same in each column. Sometimes you'll find one month is different, so it's the difference between entering in 3 numbers or 36 numbers, because it's really only one of these 2 choices. So the tax software makes the calculations, so you don't need to do anything other than enter in the 1095A numbers. So just to re-emphasize this point, if on the 1095A the 3 columns every month are exactly the same, you can just enter in the annual summaries for each of the 3 columns. If any month is different just by 1 number, then you have to enter in January through December for each of the 3 columns. And I highly recommend you work column by column and do a cut and paste. Now let's look at an example 1095A form. You'll see that it has the taxpayer's name, Social Security number, the start and end date of the policy. Dependents and spouse are also listed in Part 2. For Part 3, that's where we get the coverage information. So there are 3 columns. Column A is monthly enrollment premiums. Column B is monthly second lowest silver plan premium. And column C is monthly advance payment of the premium tax credit. That's the advanced premium tax credit that's paid directly to the insurer, and that's for the taxpayer. Now, if the taxpayer has 12 months, January through December, and everything in column A is the same, everything in column B is the same, and everything in column C is the same, then when you enter this into tax layer, you can just enter in the 3 numbers on line 33, the annual totals. If there are any differences, then you're going to have to enter in all of the individual numbers. You'll see in this case the taxpayer had coverage from March through December for each of the 3 columns, so we'd need to enter in all of the numbers. Here's another 1095A form. Notice it only has numbers from January through June. Now the taxpayer may have started Medicare in June, although in this case he appears to be too young, or he may have started a new job that offered health coverage, or some other reason. Again, if all the months aren't the same, you have to enter in the individual numbers. You can't just use the summary at the bottom. Okay, one of these numbers is a little different, but let's just assume they were all the same in columns A, B, and C for all the months. So if they were all the same, that means we'd only need to enter the annual totals in the red boxes at the bottom. So I'm going to use this 1095A to show what a corresponding Form 8962 might look like. Once we complete the Form 1095A entry in a tax layer, a Form 8962 is generated, and this is what it looks like. You see the letter A at the top. That says you can't take PTC if filing status is married filing separately unless you qualify for an exception. Now, we don't generally see this, but if the taxpayer does qualify for an exception, you just answer the question and the taxpayer would answer the question and that box would get checked. Now, Part 1 is mostly information related to the taxpayer and their income. It's all generated automatically by what you've already entered. You'll see in this case, line 5 is the household income as a percentage of the federal poverty level, and that's 353%. You can see in line 7 a value of 7.33%. Now this number is used by TaxLayer to calculate the taxpayer's contribution amount. Part 2 contains questions related to the alternate calculation for marriage. If we were to answer yes to either of these, their return would be out of scope and we need to send them to a paid preparer. So in this case, since all of the monthly amounts were the same, the annual totals were entered on line 11. It shows here that the taxpayer was entitled to a maximum premium tax credit of $16,832, as shown in box E on line 11. And they received $16,808.63 in advance premium tax credit, as shown in box 11, F. So this is the top of the form. Let's take a look at the bottom of the 8962 form. I have two different results on this slide. In the top, which actually corresponds to the top of the Form 8962 that we just saw, now the taxpayer is entitled to $16,832, shown on line 24, and received $16,809, shown on line 25. So the difference of $23, shown on line 26, is what the taxpayer will receive as a refundable credit. And if we went back to the actual 1040, you'd see that they got the refundable credit of $23. If, on the other hand, as shown in the example at the bottom of the slide, the taxpayer had received excess advance premium tax credits, meaning they gotten too much money, they could potentially have to pay it back. That's what we see here. The taxpayer was eligible for $10,000, as shown on line 24, but received advance premium tax credits of $16,809. That's a difference of $6,809. If this taxpayer's modified adjusted gross income had been 400% or above, they'd have to pay all of it back. But there's good news for this taxpayer. The taxpayer's federal poverty level was 353%, which means they only had to pay back $2,800, as shown in boxes 28 and 29. Now the level of payment is shown in the small box at the upper right side of the slide. In this case, the percentage fell in the, quote, at least 300% but less than 400% line, which lists $1,400 for a single filer and $2,800 for any other filing status. And in this case, based on filing status, this taxpayer owed back $2,800 instead of $6,809. The IRS publishes a list of percentages based on federal poverty level that show the taxpayer's responsibility. But what does that mean? For household incomes below 150% of the federal poverty level, the consumer responsibility for the second lowest cost silver plan is 0%, as you can see here in the red oval on the upper left of the chart. In other words, the subsidy offered to the consumer will equal the cost of the second lowest cost silver plan. So the consumer responsibility for health insurance gradually increases as a percentage of household income until the income equals 400% of the FPL. So household income over 400% will have a consumer responsibility of no more than 8.5% of the second lowest cost silver plan. This means a household whose income is 700% of the federal poverty level could receive a subsidy to make the second lowest cost silver plan no more than 8.5% of their annual modified adjusted gross income. Well, the 353% modified adjusted gross income we used in our example shows a 7.33 responsibility, which is in the oval on the upper right of the chart. When the family applied for health insurance subsidy, a monthly subsidy was determined that would make the annual cost of the second lowest cost silver plan no more than 7.33% of the estimated household income. You do not need to know any of these. I'm just providing that as information, as background. The TaxLayer software will calculate everything for us based on the numbers we input off of the Form 1095A. Taxpayers receiving advanced premium tax credits must file a tax return and reconcile. If not, they may lose their advanced premium tax credits in a later year. That's not up to us. That's up to Mass Health Connector, and they'd handle that. Now, in previous years, we'd find that if someone had not reconciled, basically they didn't bring in their 1095A, and so we didn't enter it in, we'd file a return, and a week or two later, they'd call us because they got a letter from the IRS saying we can't process your return until you provide this additional information. Starting in 2021, returns started getting rejected when we tried to e-file. So if a taxpayer receives a 1095A and doesn't bring it in and doesn't tell us, and we don't enter it in, when we electronically file, the return will be rejected. It's similar to if we typed in an employer identification number wrong or a social security number wrong. So it'll get rejected, and the taxpayer will have to come back in and provide us with the information from the 1095A, and we'll resubmit it. So it's worth it for us to ask a couple of additional questions to really make sure we don't miss the 1095As. It's often not our fault, but it's worth a couple of extra questions to make sure that they haven't failed to give us the 1095A. We occasionally see voided and corrected Form 1095As. If a taxpayer provides a couple of versions, make sure that you look through the dates on them. Now, if you see a void or corrected 1095A, make sure you're using the one that's marked corrected. If another taxpayer enrolled in someone else's tax family, you'll need a copy of that. Every now and then, we'll see a case where you have a divorced couple, and those can be a little bit complicated. You have to make sure that you have a copy of the 1095A that covers the taxpayer. Premium not paid. Now, every now and then, you'll see a case where the enrollment premium is zero, and then subsequent boxes are zero. That's generally that the taxpayer stopped paying. They'll not be entitled to premium tax credit in that month, and if they received it, they're actually going to have to pay it back. It may be worthwhile for them to pay it if they can by the due date of their return. And if they did it by then they wouldn't have to pay back the advanced premium tax credit that went to the insurance company. It may be worth them doing this, especially if it's a person who has a low payment for themselves and a high advanced premium tax credit. They might pay $10 and it saves them $150. Now, as long as they promise they're going to send it in by April 15th, or whatever the due date of the return is, you can still file the return but warn them. It's similar to like if someone tells you they're going to make an IRA contribution. So if they end up not making the payment, then the return is going to be incorrect and it could be subject to penalties. So it could make a big difference if they just agreed to pay that missing month. It could also be a mistake, in which case they should follow up with the Mass Health Connector to get a corrected 1095A. Again, if they don't pay for a month, they're not eligible. They don't have coverage for that month. But usually at this point it's already occurred, so that doesn't matter much. Again, it could be less expensive to pay that month's premium than to repay the advanced premium tax credit. Now, in the case of the taxpayer is under 100% of the federal poverty level, they normally would not be entitled to advanced premium tax credits. Why? Because if they're under 100% of the federal poverty level, they should be entitled to free health insurance. In Massachusetts, they'd be entitled to Mass Health. We earlier discussed a problem when a taxpayer's income was projected to be more than 100%. Mass Health would say, no, you're not entitled to free health care, so you have to get your own policy and get the advanced premium tax credit. If they did get the advanced premium tax credits, the fact that they're under 100% doesn't disqualify them and doesn't make them have to pay it all back. So people receiving a 1095A should communicate on a regular basis with the Mass Health Connector. It's in their interest that the Mass Health Connector have the most up-to-date information. Generally, at renewal time, they'll submit a new application. If there are any significant changes during the year, they should keep the Mass Health Connector people up to date, so if they add a family member, lose a family member, lose a job, they're making more money on the job or less money. Sometimes people get a better job and they're making more money, but they don't tell the Mass Health Connector, and then they still receive these high advance premium tax credits during the year. They might say, oh, I don't want to tell them because then my advance premium tax credits are going to go down. The problem with that is at the end of the year when they file their return and their income is higher, than what is projected to be, then they may have to pay some of it back. So generally it's best to keep the Mass Health Connector up to date. That's the responsibility, though, of the taxpayer. If the taxpayer is under 100% of the federal poverty level and they received advance premium tax credits, make sure to check the button that says yes. Generally, this button is by default set to no, and you're going to have to change it to yes. So the final premium tax credit is going to be calculated and put in Form 8962. Tax-Aide will get most of the information needed from the tax return that's entered. If the taxpayer has a dependent, you might have to add some information from the dependent's tax return. Now, the return may show more premium tax credit. In that case, the taxpayer is going to receive additional credit on the return. It may show excess advance premium tax credits, in which case some or all of that excess will need to be paid back. Cap on repayment is based on the household modified adjusted gross income, so less than 200%, it's a certain amount. If 400% or more, there's basically no limit. If the person or family is at 400% or more of the federal poverty level, then they'll have to pay back all of whatever the excess was. The training material says to look for cliffhangers. We do a limited amount of this, but it's something to be aware of. Watch for returns where the taxpayer is right near one of the federal poverty level benchmark limits of 200 or 300 or 400%, especially the 400%. Look to see if there are some things you could recommend the taxpayer do to get below one of the benchmarks. If you see someone's just over 400%, a lot of things kick in that are pretty negative for the taxpayer. So see if there's some things they can do to get under the 400%. That's legally, of course, like make a relatively small IRA contribution. Now, there are a number of recommendations in Publication 4012 Tab H on ways to lower adjusted gross income, like deductible IRAs. If they make a Roth or they made a Roth IRA contribution, could they turn some of that back? Now, there are a number of things you can check on. Again, if they're right on the edge of one of those limits. I do point on the slide, point out this is really for experienced tax counsels and quality reviewers. As a new volunteer, you wouldn't be expected to provide any advice in this regard. If the taxpayer is receiving premium tax credits and they're also itemizing, and in particular itemizing the medical deductions, then we're going to need to make an adjustment based on whether they're receiving additional PTC or having to pay back some of the advanced premium tax credits. So it may need to be decreased for any additional premium tax credit that's claimed on the 2024 return. It may need to be increased for any excess advanced premium tax credits that have got to be paid back with the 2024 return. For a return with premium tax credit and the taxpayer's itemizing medical deductions, you want to go to Schedule A and make an Other Medical entry. In the case of excess advanced premium tax credits that are being repaid on the return, the effect is that the taxpayer is paying additional amounts for their insurance for the previous year. So we need to make the entry a positive, which will make the deduction go up. In the opposite case, if they're going to receive a credit, they're going to receive additional advanced premium tax credits in the return, we need to subtract that amount. The reason is that their insurance is actually less than what they paid during the year because they're getting a refund of part of their insurance back. In that case, it'll be a negative amount. Now make a note in the intake form for both the taxpayer and the quality reviewer who'll be wondering where this negative number came from. So just make a note to make sure it's clear. The final PTC amount is based on the final tax return data. Remember, the Mass Health Exchange estimates are based on what the taxpayer tells them expect to make, but what they're entitled to is based on the final tax return. So think about it. I'm filing my tax return in March of 2025 for 2024 tax insurance. So the year's already happened. And that's why what I'm actually entitled to has already happened. And that's why we have to reconcile them. Now, some out-of-scope scenarios. Starting a few years ago, we were allowed to have in scope the self-employed health insurance adjustment that people who have a Schedule C are able to take. However, there are some real complications with taking this adjustment for people who have received the advanced premium tax credit or premium tax credit and have to pay back some or receive some as a refund. The adjustment calculations involved can be complicated, and Tax-Aide doesn't do this automatically for us. So if you run into someone in this case, the return's out of scope. We'll have to send them to a paid preparer. The self-employed insurance adjustment can be substantial and can save people substantial amounts of money. So we wouldn't want to just skip that adjustment for them. It'll almost be certainly worth their while to go to a paid preparer and have that done. Now, if they have a shared policy, that's two or more people in a policy, but they're filing different returns. Most common occurrence is when you have a child, adult that is, on a parent's policy, but the adult child is independent. So they're not a dependent. They don't live with the parents, but the kids can stay on the parents' insurance till 26. So you can have a 25-year-old making $20,000, $30,000 of their own money on a shared policy, but we have to send these people to a paid preparer. We can't divide up a shared policy. Now, there are some alternate calculations for a year of marriage. Again, it's unusual for us, but if someone has that situation, you can send them to a paid preparer. And finally, there's a code of FF. If you see that in box 12 on a W-2, just be aware there's some things that are out of scope. And if you see these things, send the taxpayer to a paid preparer. Of course, alert your local coordinator, and he or she is the person who will let the taxpayer know that they should go to a paid preparer. And that concludes our discussion of the premium tax credit and the advanced premium tax credit as well.